you'll see these articles coming out. And one of them that we see consistent is this idea that Bitcoin mining, which uses lots of energy, is, going to boil the oceans. And this thing is really bad for the environment. And Bitcoin should be stopped because of this. If it keeps growing, it's going to cause a lot of harm. And usually the headline that you tend to see is that Bitcoin mining uses as much energy as a small country.
This may sound very diplomatic answer that I'm going to give, or very arrogant, but we are still yet to see a good crypto media company. I'll tell you what, in traditional media, I look at Bloomberg. I don't look at CNBC as well. I'll look at Bloomberg. If the editing and programming senior management of CNBC comes up with a better strategy, maybe I'll start looking at those changes and maybe my mind would change. Michael, great to have you back. And guys, welcome to another episode of The Rundown. How are you doing, Michael?
I'm doing great. Hello, everybody, and hello, Shiv. It's great to be back. We have started holiday season here in the States. We had Thanksgiving last week, so had a nice little breather from the 24/7 nature of the crypto markets and working in this industry. But yeah, happy to be back for episode 3.
Amazing, man. And look, it seems like the crypto industry got a little bit of Thanksgiving, whether you want to thank CZ for it or whether you want to thank the DOJ for it. But it seems like the crypto market has responded well to such a big news that came out. And it seems like it's crypto industry's Thanksgiving moment as well.
It feels like it. Yeah, I think last week we just missed the actual announcement of kind of the settlement that Binance had. Yeah, I think it's positive for the industry going forward, I think. Or maybe we can just sort of break down what that settlement looks like and kind of what that looks like for Binance and CZ going forward. My understanding, correct me if I'm wrong on any of this, they pleaded guilty to violations of the Bank Secrecy Act, which is very serious allegations. I think he basically admitted to, I don't know if it was illicit finance or terrorist activities involving Iran.
Yes.
That's essentially what the penalties were for. It's over $4 billion of fine onto Binance, and CZ had to resign his position with the company. You may have more to add to that, but very serious allegations, fine. I think the uncertainty for the crypto markets, given the importance of Binance, and this is a really big deal just for the industry to have clarity moving forward. Binance has a new CEO stepping into the role. It appears they have the resources to pay this fine and move forward. I would say this is an incredibly big development for crypto. When you look at the history of financial crimes and fines for these major companies, this is the 7th largest. So now Binance is on the list with like Bank of America and Citi and Wells Fargo and some of these really massive banks that have paid similar fines. So it's kind of interesting, almost some I don't know if that's validation, but it puts crypto on the map with the largest banks, not the way you want to be put on the map, but it's kind of interesting from that perspective. But yeah, curious to get your thoughts. And what's sort of the takeaway of this, as we kind of move forward?
Tell you what, one can probably, see it coming, because Binance, I clearly remember 2017 when they did their ICO. I read their white paper. They said clearly over there that they are going to burn their tokens from all the profit that they're going to make. That eventually when, SEC were coming down against all these ICOs, they changed their white paper and suggested and removed profit from everywhere. Because if in their white paper there is a term profit there, then that basically means you're selling unregistered securities. This is a profit motive. So the genesis of Binance has always been dodgy. I'm not going to take away the credit for just the hyperscaling that company had done. To imagine that this behemoth of an organization started in 2017, and it's only been 6 years, and they are like, in one way to say, a monopoly when it comes to global trading volume and providing the rails for other regional exchanges. So kudos to them on how they scaled. Kudos to them on their success of scaling, on how they scaled. Now that's the question mark. And that's where, all this lack of risk management, lack of corporate governance, just having a Wild West attitude towards, all these laws for which they have now been fined. One can see that it was coming. Yes, you are right. And I also want to emphasize this point. While it's one of the biggest fines for not adhering to bank secrecy laws or not adhering to strict anti-money laundering laws as well, one needs to keep in mind that there have been traditional banks that have been fined more than them for violation of anti-money laundering laws. One of that bank was BNP Paribas, which is one of the most popular European banks out there. So they've been fined much worse than Binance. So for people to start witch hunting that, yes, we told you so, crypto is only for nefarious activities, this has happened with traditional banks as well that are still operational, that still have got an amazing brand equity and have been fined much more than that. So I think in a way, crypto industry has, realized that this is a sign of maturity. And that's why we are seeing crypto prices not actually crashing as one would have expected when an exchange of this nature is paying fine. I think it's a sign of maturity that, okay, this is a matured asset. They are getting fined. They deserve it. And now we're only going to see clean actors like Coinbase, Gemini, and these sort of exchanges in other countries as well popping up where they realize risk management is important and, just operate the business cleanly rather than like how Binance was operating. So I think good signs. And one more thing to probably suggest over here is that CZ might be facing a potential jail term of a maximum sentence of 18 months. But that sentence hearing is probably going to be in the next year, in the new year. That's another thing to watch out for. But one more point that I want to discuss with you. This is more of a philosophical point from my end. Sure, CZ as a CEO of Binance has done a lot for crypto industry in order to promote crypto, but I don't think we should make heroes out of people that knowingly violate anti-money laundering laws. I'll give you perspective. I'll not name these crypto leaders, but there are crypto leaders, let's say in Australia, that have gone out on CNBC and Bloomberg and suggested that we should not make heroes out of SBF or CZ. They did a criminal act, so they should not be made heroes. Just like how Dick Fold of Lehman Brothers is not considered a hero, or Jeff Skilling of Enron is not considered a hero. Similarly, these characters, they shouldn't be considered a hero. And then there are other crypto leaders in other countries outside Australia that I've been hearing are saying that CZ is undeniably a hero because of all the scaling that he's done for the crypto industry. Credit where it's due. Sure, he's done a lot. But how has he done? He's been able to scale all that because of that Wild West crypto approach. If Coinbase would have had that approach, they could have scaled as big as Binance as well. But they did the right thing. They scaled it the right way. So I think it's very important for our listeners and anybody who's new to crypto to choose their heroes in crypto carefully. Being rich shouldn't always equate to being hero. If you want to make a rich person a hero, try to find out how they build their riches and then judge whether they should be a hero or not. So don't idolize anyone just because they are powerful and rich. That's just my takeaway from that.
I appreciate that. And yeah, I think as part of the settlement too, they basically said there was never an issue with Binance commingling, funds, and the exchange is fully backed and all of that. So I think that's important that this is not an FTX situation. Binance is not, there is no evidence that Binance has commingled funds or ever lost or misappropriated user assets on the exchange. This is more related to bank secrecy, anti-money laundering laws. So that's one point I would just add. And then, as you mentioned, I think this really validates the approach that Coinbase has taken really as being the first major exchange after Mt. Gox and just really moving very slowly, watching, right? They were first, but then Brian Armstrong had to sit there and watch CZ essentially not ask for permission, instead ask for forgiveness and just sort of build this massive business. Sure, that felt very threatening. I'm sure that was really hard to deal with at the time, but to have the conviction to seek to actually take a different approach and ask for permission and go to the SEC and do it the right way, I'm very pleased to see that is working out for Coinbase now. And I think this is really important for Coinbase. And it appears to me that in the US, the regulators are going to start to buddy up with Coinbase and maybe not so much with Binance. And maybe they'll be watching that. You mentioned geopolitics last episode, and maybe there's something playing into that with Binance being primarily in the Asian markets. But I think it's really nice to see that the approach that Coinbase has taken is working out in the long run. Just really happy to see that.
Absolutely. And you want to reward your clean actors in the ecosystem, right? You want to reward them.
Yeah.
So on that note, we should move on to our other topic. But yeah, this was a good discussion, Michael. Another big news about crypto media, like the news that came out that CoinDesk was bought by Bullish, which is a crypto exchange in the US. Keen to get your thoughts, and then I'll fill my theories about this landscape.
Yeah, this is all like sort of part of the fallout from Digital Currency Group, Genesis bankruptcy, and CoinDesk is another asset of Digital Currency Group. And so I think this is all part of that, the fallout of this. I didn't see what the figure was. I don't know if you saw what the actual amount that they sold for, but you could say there were conflicts of interest with CoinDesk in the way that that was set up, with Digital Currency Group being the owners of the Grayscale Trust, having Genesis, having these other businesses around it. But I think for everything that I've heard and everything I've observed with CoinDesk is they did a good job of sort of putting up a wall between Digital Currency Group and allowing CoinDesk journalists to have, journalistic freedom. And I think that's really important for the crypto industry, because with crypto media, they're just covering crypto, right? So we need objective journalists within our industry. And this is extremely important. So CoinDesk selling to bullish potentially, changes some of the structure within CoinDesk. So it's important to keep an eye on this. I don't know a ton about the bullish folks. I do know that they were the team behind EOS, which was one of the original Ethereum killers, layer one killers that popped up. And EOS raised, I can't remember what the number was, $4 billion or something. I hope we have to double check that. Raised a ton of money, really didn't build a product. And most of that actually went into Bitcoin. So they basically put it into Bitcoin, which is probably actually working out pretty well. They also raised $10 billion to build this bullish exchange. And I don't know if that's fully come to market just yet, but it's something to keep an eye on. I think crypto media in general is something that you want objective journalists in there. And then with crypto media, you often get this combination of analysis and research reports and things like this. And this is something with my business with the DeFi report. We have a free newsletter, and we've always focused on just partnering with data companies as objective as we can. We have opinions as long-term investors in this space, but we've never taken money from a DeFi protocol or a blockchain or anything like that, because that would potentially get in the way of objective data-driven analysis. And, that's kind of something that's really important to me. And I've sort of positioned the DeFi report to take that lane, which not many people, I will say, are taking within crypto. A lot of these research shops are being paid by the companies that they're covering.
Yeah, look, I totally agree. And that's why we partnered up, right? Because I respected you so much. And that is something similar that I get told by my students as well, that why don't I associate myself with these blockchain protocols, and why don't not you talk much about it? And I tell them the similar analysis that, I came with the promise of decentralized technologies. I do not need to get paid if I feel like this project deserves to be talked about. And the ones that generally pay you to be talked about are generally not worth talking about it. That's why they require that advertisement. That's why I'm an independent. But yeah, look, good points out there. For people who are not familiar with me, you are going to hear a lot of philosophical inputs during my conversations. So I just want to make a quick note about what you said about CoinDesk. When you think about it, this whole saga of pain that the crypto industry faced since last year, yes, Terra Luna happened and 3 Hours Capital happened, but the big Armageddon that happened was basically the FTX scandal last year, right? And that originated because of the Alameda Research leaked financials by CoinDesk. And when you think about it, the whole, flywheel of cascading effects that happened, that affected Genesis bankruptcy, that in turn later on, one can argue, accelerated DOJ's decision against CZ, also because of FTX bankruptcy, also happened because all of the leaked financials by CoinDesk. So in a way, fractal theory and chaos theory and the fragility of life played out in front of us in just 1 year, that the journalists at CoinDesk had no clue that what they are going to leak out in terms of news, which is good that they did, by the way. It's great. That's great journalism right there that they did. But they didn't know that what they're going to do eventually means in a year's time that their business is going to get sold out, right? How crazy things happen.
That's pretty wild. I hadn't even really connected all of that. But yeah, you're essentially right. That story is what kicked off the FTX. I think it was basically the holdings of Alameda people started looking at, and then Binance saw the story, and then they sold FTT token, and that kicked off the bank run. It's super interesting. A year later, you have bankruptcies, you have Sam Bankman-Fried in jail, and now you have the media outlet that broke the story with a new owner. Wild. Yeah, that's a story only you could see in crypto.
Yeah,
right there.
But nobody would have expected it. Digital Currency Group, they wouldn't have expected that this would be effect of the news as well, that eventually their subsidiary is going to get bankrupt. CZ probably wouldn't have expected it, that when he's posting it out as a tweet, that, we're selling FTT tokens as risk management strategy and talking about SBF, that he'll eventually, in a few months' time, would plead guilty for doing terrible things as well. Not commingling funds, but basically putting a blind eye for anti-money laundering laws. So it's crazy how things happen. Coming back to crypto media landscape, absolutely right. We've seen this at the end of the day, whether it's crypto or whether it's traditional finance, it's people running business for other people. And with that in mind, we've seen what has happened to traditional media that, eventually commercials talked and then propaganda and agenda is driven. If not now, we might end up seeing that in crypto as well, if we've got very concentrated ownership of media. So according to me, after this news, I see a big white space for crypto media entrepreneurs to step in and build more IPs that support, like we are suggesting, objective, data-driven journalism rather than agenda-driven or taking money, sponsorship money, and shilling their tokens. So I see a big, big white space when it comes to crypto media, and it's a vertical of the crypto industry that I'm actively looking at.
Yeah, I know for myself, I've sort of moved away from a lot of more traditional media outlets like the New York Times and, a lot of those, they've moved to like more subscription-based business models. But, I write a DeFi Report is a Substack newsletter publication. I get a lot of my news and content and sort of what I feel is more signal versus like someone's agenda that they're pushing out there through these more independent venues. So I think that's sort of interesting to see, like, where the Substack sort of business model leads to. What does that mean for some of these larger kind of media organizations over time? I think the internet is still sort of like scaling out, and we're still sort of seeing how this is playing out with social media. So it's kind of interesting to me. I'm curious from your perspective, who do you think is the best media like company in crypto? Like, where are you getting most of your information?
This may sound very diplomatic answer that I'm going to give, or very arrogant, but we are still yet to see a good crypto media company. I'll tell you what, in traditional media, I look at Bloomberg. I don't look at CNBC as well. I look at Bloomberg. If the editing and programming senior management of CNBC comes up with a better strategy, maybe I'll start looking at those changes and maybe my mind would change. But at the moment, when it comes to traditional financial media, Bloomberg is what I watch. In crypto, I don't follow anything. That doesn't mean that I don't see news on the various crypto media websites there are there. If you want to know from where most I used to get my information from, I used to get it from CoinDesk. That's what I used to watch. But then again, I didn't find their media delivery or research at the same standard as what Bloomberg provides for traditional media. So that's where I'm suggesting that we're still yet to see a crypto media company at that stature. But with what we've got so far, I used to follow CoinDesk. And now that it's bought by a crypto exchange, which has got history with EOS, and I'm being blunt over here, I'm not a fan of EOS. I've never been a fan of EOS because I've seen their trajectory since their ICO days. Yeah, that's why I believe that there is a big scope for crypto media.
I think Blockworks does a good job and they're very positive for the industry. I saw Jason Yenowitz, one of the co-founders, put out a tweet thread on this subject, kind of his thoughts, this is probably good for Blockworks, the fact that Bullish is now involved, but it's maybe not great for the crypto industry. Like, I've had positive interactions as well with folks over at CoinDesk. I've been a guest writer on their platform before, and I know there's a lot of good people working over there. So I just hope, just because you have these potential conflicts of interest doesn't mean that they will persist. We've seen, I'm in the Boston area, and, the owners of the Red Sox bought the Boston Globe, right? And they can sort of control like those to sports media business is really, really like a fervor in the Boston area. And so like that's a strategic move for them. And that obviously that's a conflict of interest. We see this, Amazon and Jeff Bezos bought the Washington Post, right? So this is everywhere. This is almost how media works these days. Unfortunately, there's not a real distinct line all the time, but that doesn't mean that everything you read is, someone's agenda or someone's. So it's just how they execute this going forward. And I think we have to give them the benefit of the doubt to start anyways.
Yeah, look, I totally agree. They have the benefit of doubt, but yeah, I still think it's a white space. I think there needs to be more competition. Like you mentioned, whether it's newspaper, but then again, it's the benefit. Newspaper is more than a century old industry. Same with television news broadcasting. So I see in crypto as well, we're going to see more competitors in the media space. Like you said, Blockworks, CoinDesk. There are not many crypto media IPs out there. You want more competition. So I think we're going to see more competition in the crypto media company. companies.
I would agree. Yeah, it'd be interesting to see. I mean, the industry is still very, I know some of us, you've been in this industry for a long time, but it's still so early.
Agreed.
So things are going to evolve, things are going to mature as the years pass here.
Talking about maturity, let's talk a little bit about Bitcoin and its relationship with energy and what everybody gets wrong about that. So Michael, I want you to start off as to what people get wrong about Bitcoin and energy consumption, and then I'll go second.
Yeah, this is a juicy topic here. We brought this up last week, and it's a bit of we thought, this week it'd be nice to spend 10 or 15 minutes just addressing this topic. I think it's really important for people to kind of go under the hood on this a little bit. This is a topic that we've seen, you sort of have these FUD, fear, uncertainty, and doubt cycles in crypto, and it tends to be during a bull market that you'll see news articles coming out. And one of them that we see consistently is this idea that Bitcoin mining, which uses lots of energy, is, going to boil the oceans, and this thing is really bad for the environment, and Bitcoin should be stopped because of this. If it keeps growing, it's going to cause a lot of harm. And usually the headline that you tend to see is that Bitcoin mining uses as much energy as a small country. Right. And that sort of just captures people's attention. It's like, oh my God, that is true. I don't think anybody in the crypto industry has ever disputed that fact. But I think the next sort of layer to go into this a little bit is to say, okay, how much actual energy is that? What percentage of global energy consumption is that? When you kind of get under the hood, it's between 10 and 20 basis points of the global energy consumption, which is between 1/10 of 1% and 0.2 of 1% of global energy. So I think just kind of putting that into perspective is important, just on okay, that's how much energy it uses. The next sort of layer deeper here is to say, well, what does that actually mean? What's the energy mix, right? Just because you're using energy doesn't mean it's somehow, bad for everybody. And there's a Bitcoin mining council now. We could say that maybe that's somewhat biased. We probably need a third-party audit there. But this stuff is actually pretty traceable in terms of what energy sources are actually being leveraged to mine Bitcoin. It's about 60% renewable energy is where it's coming from. And the reason for that is that the largest cost to be a Bitcoin miner is the operating expense related to the energy consumption. And so if you're a business owner, you're a capitalist, you're looking to make your operating expenses as cheap as possible. And renewable energy happens to be cheaper in most cases than fossil fuels, right? And so that's why we've seen, and this is one of the reasons why Bitcoin mining was so concentrated in China up until 2021 when China banned mining, because the Communist Party of China had overbuilt hydroelectric dams in the middle of the country. There was all of this excess energy that was essentially being wasted. And so this is where Bitcoin mining is really, really unique, and that this is a location agnostic load resource that can locate anywhere next to cheap energy. And so they're over there just mopping up that basically free energy, which is kind of a gift to that energy resource. Now you have a new buyer that wasn't local, right? Nobody else can come and just relocate there and be a really strong source of demand for that energy. So kind of when you start to combine these things, the story becomes much more nuanced. We can get into sort of some of what we're seeing down in Texas and how we're using Bitcoin mining to sort of build out renewable energy sources. But I think those are the main things, is actually how much energy is it? What is the energy mix? And then why is Bitcoin mining interesting in terms of how it can actually help the build out of renewable energy sources? Those are kind of the areas that I focus on. I actually think this is the most fascinating thing related to Bitcoin. Bitcoin, of course, is proof of work. This ties Bitcoin to the physical infrastructure of the world as well. But yeah, I would encourage people to just go a little bit layer deeper. And then through studying Bitcoin mining, that is the way to deeply understand Bitcoin's foundational economic incentive structure. And if you do that, you will come away feeling wow, this Bitcoin thing was built bulletproof. There's economic incentives built into this thing from the bottom up, and it looks bulletproof. The learning that you can take from studying those token economics and the incentive structures there can be applied to almost any other crypto project that you look to study and understand. But yeah, that's a bit of a ramble there. But yeah, I'm curious your perspective. That's kind of what I focus on with Bitcoin mining. I will say, over time, we are seeing this story sort of, we're seeing a lot of coverage now. KPMG put out a report basically talking about a lot of what I just mentioned, the ability for Bitcoin mining to help drive renewable energy build-outs. But it's a nuanced topic. It's complex. Most people are not taking the time to really dig into it.
We'll probably do a special episode, and probably a longer one, on the rundown where we just talk about, Bitcoin mining and all the intricacies that go to it. and why a lot of people, me including, believe that it's bulletproof money. So look, I'll start off by saying firstly that you explained it very well. I'll only add to what you said, and that is firstly starting off by talking about the elephant in the room around this. Because one thing to acknowledge is that the biggest influencer in the current world is Elon Musk. Elon Musk at the moment is the biggest influencer in the world, more than heads of state, more than Joe Biden as well. I'll just put it out there. If he tweets that buy Doge, people are going to buy Doge. And smart people that I know, this is like in front of me, smart software programmers who used to believe that Bitcoin is superior than Dogecoin, which honestly should be a no-brainer. They also started believing that Dogecoin is superior than Bitcoin because of the Bitcoin's proof of work consensus system being very expensive, both on environment as well as monetarily. So Elon Musk is the biggest influencer in the world. And I'll just say that when he made out that statement that it takes a lot of energy and it's bad for the environment, Bitcoin network doesn't tell you to use fossil fuels. Just like how Tesla cars doesn't tell you to use fossil fuels. Tesla uses electricity to, fuel your car. Similarly, the Bitcoin network uses electricity to, fuel the Bitcoin network. It requires energy. How you use that energy is up to people who are running these Bitcoin mining companies, right? So I think, first of all, it's very important to address because I know that a lot of our listeners would be Elon Musk fans as well. And look, I'm a fan of Elon Musk as well for all the great work that he's done. But you got to call a spade a spade. If you buy a Tesla car and you're okay to drive it because it's electric, then similarly, Bitcoin network uses electricity. You should be okay to use it. There should be no conversation about from where the energy is getting sourced, just like how nobody asked a Tesla car owner where the energy is getting sourced. Is it solar or is it fossil fuel based? So I think it's very hypocritical. I just want to suggest that because a lot of people just use the Elon Musk tweet as a cop-up that, Elon said that it's bad for the environment. No, you got to call a spade a spade. If running an electric car is not bad for the environment, running a Bitcoin network fueled by renewable energy is not bad for the environment. Now that brings me to the second point that a lot of people say, which is that, going from point A to point B is a very important thing. It's part of human mobility. So that is an important activity that is being fueled by Tesla Motors. But Bitcoin is a speculative asset. And, what value is Bitcoin adding? Well, that's where I think a little bit of more broad-mindedness is required. When you go to a country like Argentina, when you go to a country like El Salvador, when you go to a country like even Turkey or even Venezuela, Zimbabwe, when you go to these countries, which we do not really talk about because they are not, a G7 economy, they're not a, multi-trillion dollars worth of economy. But in terms of the human capital, there are among all these countries that I've mentioned, close to 1 billion people living. When you ask them that whether their national currency, which is losing their value, Argentina has got an inflation rate of more than 100%, will not even go to Zimbabwe. When you ask people living over there, do they have a store of value in their national currency? The answer is no. And then what do they rely on? They rely on the US dollar. US dollar is the safe haven currency for the world. No doubt about that. That's why the US dollar is so strong. But we know how US dollar has performed against Bitcoin. We know how US dollar has kept its store of value with the increase in inflation rate and the decrease in its purchasing power since, Richard Nixon's decision of removing the gold-backed currency. So if the safe haven currency of the world has depreciated so much, what hope do other countries have got where their national currency is, basically depreciated to not even worth the paper that it's printed on? So that's where my argument comes in. I know that there are countries that don't like to term Bitcoin as money. They can choose to do that. If you want to call it a commodity like gold, call it a commodity like a gold. I believe it's better than gold. But coming to the point why I brought it up, Bitcoin is the most important monetary experiment that we've seen in our lifetime. And if somebody thinks that it's not important for all the energy that is being used to support that network, a decentralized network, then I do not know what more is important. Money is the most important social contract. And if Bitcoin is not important to run, then I do not know what more is important to run. So I just wanted to say those 2 points.
I think just to add, this is a big topic and we will probably do a full episode, like you said, and this will probably come up during the bull the next bull market. So we'll have plenty of opportunities. I think you're totally right that like this point that I kind of wanted to touch on this energy thing, and like really what your work is. When you get paid for your work, you're trying to store your energy. And so the fact that Bitcoin leverages energy to produce it and then it stores energy in a digital form is very interesting. Like, you mentioned philosophy, like we're going into like a philosophical area here, but actually Henry Ford was philosophizing that like we should have a currency backed by energy. And that is what Bitcoin is, really. You're leveraging energy to create a digital form of it that then stores the value of that energy. So super interesting. That's a rabbit hole on its own. But I think what you said at the end there is super important too. What ends up happening with this argument about the energy is that it just doesn't stand up on 2 feet when you start to dig into it. And what you learn is that the people that bring up this argument, they just don't like Bitcoin. That's actually what the problem is. They just don't like it. For some reason, and typically that there's ignorance there and why they don't like it. But that's really where this comes from, because the argument doesn't stand on 2 feet once you start to get into the nuance. You could probably end it there, but I think this is a fascinating topic and it's a rabbit hole discussion.
Maybe that could be our first 7-hour episode special of the Rundown, where we go deep into this topic. But Michael, do you think it's now time to go on chain?
Time to go on chain. Let's do it.
Time to go on chain with Token Terminal. Amazing, man.
All right, so for this week's segment of going on chain, like I thought we would touch on the subject of L2s. This is becoming a pretty important topic. And just to give people sort of a high level overview of what is an L2, this really comes back to the challenges with scaling, layer 1 blockchains and this idea of like the blockchain trilemma, which is sort of this intersection of security, decentralization, and scalability. And the idea here is that you can typically get 2 of those and you can't get the third. And so the way this comes into play with Ethereum is that they've sort of optimized for security and decentralization. So decentralization, everyone can have access and run a node. It's easy to do so. But because of that, that constrains the ability to really scale the network, similar to how you would think about, the early days of the internet. And we really couldn't scale the internet until we had broadband. And I sort of view L2s as this broadband moment for public blockchains. And when it comes to these L2s, they are separate blockchains. You can think of them as sort of outsourcing the execution that the app layers are leveraging, right? So the apps will leverage L2s for faster transactions, higher throughput, lower costs. And then the L2 has a relationship with Ethereum where it's anchoring all of that, the proofs of all of that data on the L1, and it's paying to do so. So really the business model of an L2 is sort of reselling block space on the L1. I think a nice sort of analogy with like an L2 is like when you go to send, really large files, maybe a bunch of really large files in an email, oftentimes you have to put that into a zipped folder, which is compressing the data and then allowing you to make that to send that. It's the same idea. The L2s are batching transactions, compressing the data, and then that's getting anchored to Ethereum. So really the analysis here, and I'll pause in a minute, Shiv, to kind of get your thoughts. But the analysis to me with L2s is that, Ethereum is scaling in a modular format. So this is introducing complexity if you're an analyst and you understand that Ethereum's product is block space. If that block space is being scaled on a layer 2 that has a separate business model, how does that start to impact how we think about value accrual through the tech stack? I will pause right there.
What I'm going to do is I'm just going to quickly open up my calculator, because this is an important topic to talk about when people say, what's the value of L2? And this is where we need to touch upon. So let's say Ethereum, as of their vision, they are suggesting that theoretically they should be able to facilitate 100,000 transactions per second, right? So let's say, 24 hours, 60 minutes, 60 seconds, 100,000. So in one day, there are 86,400 seconds. That's the amount of seconds that we've got in one day. And then if we multiply that by 100,000, so that means that theoretically in one day, if Ethereum reaches its scaling, we'll be able to facilitate 8.6 billion transactions in one day.
Per day.
Yeah. 8.6 billion transactions per day. That's the maximum throughput for Ethereum if they are able to achieve the 100,000 transactions per second, 8.6 billion. Now, if we believe that Ethereum is going to be the settlement layer for the internet and they are going to do a lot of transactions, by the way, for people who are new to crypto, a transaction in Ethereum is not just limited to me sending Ethereum to Michael. It means that any of the DeFi protocol or any of the social media decentralized protocols that are built on Ethereum each like would be a transaction. So for me, if you look at the current version of internet, or even if you look at one of those Facebook, if you think of Facebook as a protocol, in one day, there are more than 8.6 billion inputs or transactions that happen. I mean, on YouTube, every second, there are 15 videos getting uploaded, right? So when you think about it, 8.6 billion transactions per day is actually not the entirety of the internet. So that's why we need a bigger scaling option if we believe that Web3 is the future of internet and Ethereum is the dominant settlement layer for the internet. That's where we need layer 2s like Arbitrum that helps to compress all other transactions out of those 8.6 billion in that single day so that Ethereum is not congested, as per your analogy. I just thought of pointing that out.
Yeah, no, that's super helpful to put some numbers behind it. And this is part of the analysis that we're working on actually currently, and hopefully have some really interesting insights to share soon, where when you start to think about, okay, if all the transactions or most of the transactions move off of L1, so currently about 5% of the Ethereum gas consumption is coming from L2s. Actually, I'm sorry, it actually went up to 8.8% over the last 30 days, and it was at about 4% last year. So we're seeing more transactions, more applications deploying on the L2s. And so what we're sort of modeling out here is as the percentage of transactions increasingly move to L2, how many of those transactions can be batched into one Ethereum transaction? And we know Ethereum is basically at capacity today. And so what does this start to look like? And as L2s become even more scalable over time, we expect over time Moore's law to play out and even more transactions can get packaged into one batch. What does that look like? And how is the market going to start to think about this? Is the market going to value settlement, which is really what Ethereum's role is going to play here, over execution? And where are the assets going to sit? Are they going to sit on Ethereum as sort of this like incredibly secure, decentralized infrastructure for the internet, and people sort of use the L2 for really more execution? These are all the things that we're trying to think through. Some of these L2 networks have tokens, and some of them don't. Base was recently launched by Coinbase. I recently covered Base through the DeFi report. People can check that out, but they don't have a token. Arbitrum does have a token. And what is the utility of that token? When you think about Ethereum, there's clear utility. You need Ethereum to pay for services. Like you said, any transaction, not just sending Ethereum, but any interaction with the blockchain is a transaction. That is not how you pay for interaction on L2s. You pay with Ethereum. You don't pay with their native token. So where is the structural demand for the L2 token? What is its utility going forward? These are the things that are really important to kind of have a thesis for today. But I just sort of intro people to this. I think one more thing before I sort of show what's happening with Arbitrum is a mental model for people to think about how this is sort of growing out. Is Ethereum is scaling similar to the internet as like a network of networks, right? Ethereum is sort of the base layer of the first network, and now you have the L2s building out this network of networks. For example, Arbitrum is a layer 2, but they're creating a network themselves, and they're making it easy for developers to come in and build their own app chain within that ecosystem. So the mental model for me is sort of like Ethereum is kind of like the internet, and then L2s can sort of be used for various geographies, right? So maybe like maybe China wants to build an L2 and sort of ring fence that, just like they did with the internet. I could see that type of thing playing out here, where you have this global shared settlement layer, and then you have the ability to create L2s that serve various geographic regions, serve various use cases, various, legal jurisdictions and things like that. So that's kind of one way to think about this. But just kind of jumping over to the data here with Token Terminal.
Before you jump on the data, I would love for me as well, but also for our listeners and viewers, if you can click on the famous business model button of Token Terminal that really gives a good introduction. Okay. So this is the business model of Arbitrum, right?
This is the business model of Arbitrum, exactly. And yeah, so what they're showing here is like a user comes in, let's say the user pays $100 of transaction fees. What Arbitrum's business model is doing is connecting the user and the L1 validator. So $100 goes through Arbitrum, and then about $80, that's kind of the margin of how this is working out today, and I'll get into this in a minute, is being actually paid to the ETH validators. So if a user pays $100 through Arbitrum keeps $20. The other $80 goes to the Ethereum validators, and it's first out that way. So that's kind of the business model. Like I said, they're sort of reselling Ethereum's block space and providing execution services to the application layer of the tech stack. And so, yeah, when you kind of think about what's going on here, how is Arbitrum? I think the L2s were not really part of the narrative of the last sort of adoption cycle. The L2s really launched late in the cycle. And so we were really hearing about the alternative layer ones as the solution to solving Ethereum's scalability problems. That's where Solana, Avalanche, some of these alternative layer ones popped up. And so what I've been doing is really trying to understand who is actually progressing faster and showing more network effects. Is it the Ethereum L2s, and are they benefiting from those existing network effects within Ethereum? Or is Avalanche and Solana and some of these other alternative layer ones, are they actually growing faster than the L2s? And I'll show, we have some comp data to look at in a minute here. But just to show how this is working, like we mentioned with the business model, over the last 365 days, Arbitrum has done over $51 million in transaction fees paid by users that are leveraging applications built on their L2, right? And they're paying for those fees in ETH, not in the Arbitrum token. Paying for those fees. Of that $51 million, $37 million of it was paid to the Ethereum validators, anchor that data, all the proofs of that data to Ethereum. That's kind of the model so far. That margin is shaking out to about, it's around 25% right now. And so, as you're kind of thinking about this, if you're an investor, what should Arbitrum's valuation be relative to Ethereum, for example? And I think if you just start to kind of map this out and look at those valuations, you could sort of apply, okay, maybe it should be worth somewhere between 10 and 20% of Ethereum. And that's like just a starting point to kind of think about this. Like I said, we're going to be doing more analysis where we're modeling out kind of transactions and what these economics can look like. But this is just a really super important thing for people to kind of have a thesis for. My high level view here is that ultimately there will be more value on the layer one. So there'll be more market cap. And also that's where the assets will sit. But there's probably more upside if these L2s are successful, where they're going to capture maybe more of an investment return than Ethereum might capture going forward. And Ethereum sort of plays the role as almost like an index fund, where you have new L2s coming in and building on top, just like you have new companies rotating into the S&P 500 and they're driving value to that. If you invest in the S&P 500 index, I sort of see Ethereum as that index fund. And then there's obviously more risk because you have to pick the correct L2 if you're going to make those investments. Maybe you invest in a basket of them. But that's kind of how I'm thinking about sort of this value accrual through the tech stack. We've written about this recently with a lot of token terminals data. Did you have anything to add to that before I show some of the comps data?
I was going to probably just add, and this might be my opinion only, but I like to believe that when it comes to L2, Polygon did a lot of work, so that's probably an exception. There is Solana, of course. There is Avalanche. Near Protocol is also one of them that tried to get a lot of activity as a competition to Ethereum. But when it comes to a layer 2 protocol, I feel Polygon did a lot of work. And since Arbitrum is an L2 as well, I would love to see, if not now, but in future episodes, like the competition of Arbitrum versus Polygon, and even adding Immutable X to it as well. Although Immutable X is targeted just for gamings, Web3 games, so of course it's not an apples to apples comparison, but I feel Arbitrum and Polygon would be an apples to apples comparison, especially since Polygon had an early mover advantage. Polygon has been operational since the 2020s, and they raised a massive $450 million venture capital round, and they got that money and then they scaled even more. They got the head of YouTube Gaming as their CEO as well, who then eventually resigned. So yeah, I would love to see a comparison between Arbitrum and Polygon, if not in this episode, but in future episode.
I do think I have Polygon on the comp, so we'll get to that in a second. But yeah, just you were mentioning transactions per second and how many transactions these things are going to potentially be handling going forward. And you can see here, I just toggle this over to daily transaction counts. The network is doing, it peaked out at 2.4 million transactions just a couple of days ago. For reference, Ethereum itself as the layer 1 is doing around 1 million or a little bit over 1 million. So you're seeing the L2s on their own already start to outpace Ethereum. Obviously, there's more than one L2. There's Optimism, like I mentioned, there's Polygon, there's Base, there's ZK Sync, there's Immutable, and some of them have different sort of niche use cases that they're going after. But, this is sort of impressive to see the growth, but we are still just very, very far away from onboarding 1 billion users here. And like in terms of the transaction per second right now, it's nowhere near where it needs to be, right? These transactions per second are like sub 10. So like the most we've seen over the last year is 32 transactions per second. So this is nowhere near where it needs to be. Even the L2s, there's tech upgrades that are coming. EIP 4844 is upgrade for the Ethereum. EIP stands for Ethereum Improvement Proposal. So that will make L2s more scalable. This is still an open question, right? There's still lots of people out there that say, well, this might not be possible. We might not be able to get to this, billions of users onboarded through L2s. We will see. It's something we're obviously bullish on. But if you talk to people in Solana, they will tell you that what they're doing in this more monolithic approach, which maybe we'll get to in another episode, is really the answer to blockchain scalability. Time will tell, obviously.
But the good thing to note over here, right, especially for our listeners, is that we are already working and building the infrastructure that would be ready for the Web3, or the blockchain-driven internet. So infrastructure is already getting developed. And look, this is what we aim to highlight through this podcast, right, Michael? We're not drawing lines on a chart telling you where the price is going to go. This is the information that you need to be seeing in order to understand the fundamentals, so that you go back and sleep, and then wake up tomorrow and realize that all these price movements that you see for these tokens, this is the actual fundamental layer that is actually driving the price. But yes, of course, majority of the price movements is all hype and, YOLO activities, because we live in the generation where dopamine hit is constantly required. But there is fundamentals. So for all those people that think that, is there value in Arbitrum? Because, what it is just a speculative asset. This is the value in Arbitrum. This is the business model. And this is the infrastructure that is developed. Just like how Visa and MasterCard, they process transactions, and that's why their network has got value, which is why they are, people speculate on their price movements. This is the value of these networks, like Ethereum and Arbitrum. And this is where Michael and I are trying to showcase with this podcast, thanks to the data powered by Token Terminal. So next time, if you have seen this podcast and you go, I hope that you do not say, or if somebody tells you that crypto is useless, it's all speculative, it's only used for nefarious activities, at least now you can say that these are some of the fundamental layers that drive the fundamentals and price movements of crypto, starting by Arbitrum now that we've exposed it.
Yeah, thank you for that. It's a great point. And we've seen this before when the internet came of age, people didn't understand what the business model of internet companies were. I remember when Facebook went public, which is pretty far into their story, Wall Street did not know how they were going to make money. It's the same thing. You can see when you're infrastructure, but I like how you mentioned Visa, MasterCard, because when you are infrastructure for global commerce, that is where you want to be. That's why these are potentially extremely valuable. So just to drill in and share some more data here again from Token Terminal on the comp. So one thing that we've been looking at is not only how do the various L2s compare against each other. These are all separate teams. They're separate organizations, separate development teams, but also how do these compare against the alternative L1s? Again, the L2s really were launched after the L1s. So you would think that maybe these L1s are actually showing more users and more total value locked and more transactions. What I'm observing is that the fundamentals look stronger on the L2s within Ethereum than the alternative L1s. So if we just sort of compare Arbitrum to some of these other L2s here, what we can see is Arbitrum has the strongest fundamentals across the L2s. They have the most, I'm going to step back and just say that Polygon is actually more of a side chain. And this is sort of a technical distinction where Polygon actually uses Matic just to pay for transactions. So it actually functions more like a layer 1 blockchain, with the caveat that Polygon anchors their data back to Ethereum because they want that close alignment with Ethereum. So there's this concept of a roll-up versus a side chain. It's sort of a technical thing. Polygon is a side chain. It's almost more of an L1, but for the sake of this discussion, we'll consider them an L2. And Arbitrum is winning on revenue. So that's one thing we can look at here. In terms of gross margin, Polygon is always going to be much higher because of that distinction where they're using their token to pay for services. In terms of active users, Polygon is the winner here. Arbitrum comes in number 2, and important to see that like these L2s are stacking up pretty well against Solana Solana and Avalanche. I'm looking at this line here, whereas, Avalanche has seen a pretty high market cap, much higher market cap than the L2s, but you're seeing from a fundamental perspective, a little bit less usage there. In terms of transactions, Polygon is the leading L2. It's also leading in terms of cost per transaction. Polygon's the cheapest. It's also driving the most transactions, but these other L2s are looking pretty strong as well. These fees need to come down even much farther. 21 cents, Polygon's at 2 cents. That's pretty good. That's still going to drop farther. Arbitrum's at 17 cents per transaction. Then you have Base at 11 cents. But I think that the main takeaways for me when I'm looking at this is, which of these L2s looks like it has building out network effects within Ethereum and is going to be sort of like a network of networks within itself and building a thesis around that. And then the other piece of it is, how does that compare to these other L1s? And if the L2s are successful, where does the value accrue? Does more of it accrue to the L2, or are you safer just being in Ethereum? And so I'll pause there to get more of your thoughts. And I'm probably sharing too much information for the viewers out there. I suggest people check out the report, the DeFi report. We covered Base. We also covered Arbitrum recently, and we've got a report on Avalanche coming as well.
Yeah, look, I think this is great. So yeah, definitely. I think any listener over here, any viewer, they should go check out DeFi report, and especially this latest research, because this particular analysis is a piece of gold. Honestly, this is great to do this analysis. I'm glad that you pointed out that Polygon is more of a side chain, and it's not really, yes, it is layer 2, but there is a distinction between how Polygon operates and what the role its token plays to what Arbitrum plays. But this is very useful quantitative analysis and comparison between the different L2 and L1 operators over here. I do think we should end this podcast episode by me asking you a request, because I'm very particular about the decentralized quotient. That's the whole point that why I got into crypto. So I think, Michael, what would be great is in future analysis, we can somehow find, just like how there is the Nakamoto coefficient in order to evaluate, how decentralized a certain protocol is, maybe if we can somehow incorporate within the DeFi report itself somewhat of a metric like Nakamoto coefficient to suggest how decentralized each of these networks are. And the reason why I feel it is important is we started the podcast episode, we spoke about Bitcoin. Bitcoin, a lot of people would argue, is bulletproof money. But we would never say the same thing, let's say, about Solana. There are countries like El Salvador has already incorporated. Argentina is thinking about incorporating Bitcoin as a national legal tender because it's decentralized. Nobody would say the same thing, or I wouldn't talk about Ethereum, but let's say Solana. Nobody would say the same thing that let's make Solana a legal tender for a country, because it's not decentralized. And that comes to the question that maybe some of the protocols, even if they are not decentralized, they might be good for, let's say, building Web3 games, because building Web3 games is not as big of a social contract as building, a monetary asset. So having that metric in order to evaluate how decentralized these different protocols are, I think would add a lot of value to our listeners and users as another metric to evaluate the valuation according to them.
No, I agree. I think that's probably the value prop when you think about the L2s in particular of Ethereum as sort of the more decentralized settlement infrastructure. And I think it's one of the reasons why I think most of the value will actually be held, even though the execution will happen on the L2. Most likely the value stays on the L1 as secure kind of settlement infrastructure. But yeah, just to touch on what you mentioned with the L2s, they are very centralized today. They have a centralized sequencer that is essentially, it's not the same as Ethereum where you have a distributed network of nodes and everybody can participate in that. They have a centralized sequencer that is ordering the transactions, right? So there's potential centralization concerns there. The way that is being dealt with today is that for every transaction that runs through an L2, there's a 7-day, they call it fraud proof period, where anybody can essentially audit the transactions that go through the L2, and then those can be reversed via the L1. So there's a mechanism there where they're sort of leveraging Ethereum's decentralization to solve for some of that right now. But in the future, these things need to become more decentralized for various use cases. Like you said, there are certain things where there's a trade-off. Like if you're playing a game, that probably doesn't need to be as decentralized as if you're doing something with DeFi and there's a lot more value and it's financial in nature. And so I think we'll see that sort of play out as the space matures a little bit. But I love the idea of having that metric. There's Nakamoto coefficient for like layer ones. We haven't really seen that for layer twos just yet.
So look, before we sign off, what should our listeners and viewers expect for next week now, Michael?
So next week, I'm thinking we're going to go through DeFi protocol. And so we've covered sort of business model of Ethereum last week. We shared some data on how we think about that. We covered L2s here. I think we'll show probably a DeFi protocol, maybe Uniswap we'll focus on next week. We'll go through that business model. And that gets interesting as well when you think about where Uniswap is deployed, because Uniswap is deployed on the L1, but they're also deployed now on these L2s. And so when you think about how value accrues to Uniswap liquidity providers versus Ethereum validators and like the MEV capture, we'll get into some of the nuance of value accrual through the tech stack when a user transacts through an L2 on Uniswap versus directly on the L1 on Uniswap. So that should be interesting for the viewers out there. But I'd also like to just throw out there, if you're watching this or if you're listening to it, please leave us a comment on YouTube. Let us know if there's something that's interesting to you, or if we're covering these topics in a way that is not as easy to follow. Please just let us know and we'll correct that going forward.
Amazing. Look, on that note, signing off. Thanks for watching. As Michael said, do let us know. DM Michael or me on LinkedIn. We are very approachable individuals with your feedback. But yeah, if you got interest for us shilling tokens, probably not the best DM, because we'll not do it. I think this was great, Michael. You gave us a deep dive on this competitive analysis, which is a piece of gold. So definitely, guys, check out DeFi Report. And yeah, looking forward to a Uniswap analysis, because that is a gold of a application. That's a great decentralized application, one of the best out there to showcase the power of decentralized internet. So looking forward to next week, Michael.
Likewise. Yeah, thanks everybody, and we'll see you next week.
Amazing. See ya.